So, while in chapter 10, we examined risk and return characteristics of one asset at a time, in chapter 11, we're going to consider portfolios of assets. We're going to mix one or two, well, three assets together and see how the risk and return of a portfolio of multiple assets behaves. So in this first example, we have two assets. We have Apple stock, and gold ETF. It's an exchange traded fund that invests in gold. And I want to see how a portfolio of mixing these two investments would behave. And we're going to mix these two investments, Apple and gold, in different proportions, because we can mix them. We can do 50-50, we can do 40-60, and so on. But we're going to do it by 10 percentage point increment. And we're going to start with weight of Apple being 1. So 100% Apple, all the way down to 0% Apple and 100% gold. Here we have some monthly returns on those two investments. And so let's calculate what would be the rate of return on mixing these two investments. So let's type this in as a formula. So we're going to start with, I'm going to put a weight of Apple, which in this case is E4. And we're going to want to copy that first across different columns, and then we also want to copy that down across different months. And so when we copy that across different columns, we want the weights to change. So we want the column coordinates to change. So we're not going to lock the column coordinate, but we are going to lock the row coordinate, because when we copy this cell down, we don't want it to change. We always want the formula to grab the weight from row 4. So this is the weight of Apple. It's going to be multiplied by the return on Apple. Plus, we're going to do 1 minus the weight of Apple, locking in the row coordinate, times the rate of return on gold. So basically, the return on the portfolio is just the weighted average of the returns on those two assets, where the weights is the relative proportions in which we mix those two assets. So if I hit enter here, well, actually, I need to be thinking about locking some of these cells too, because when I copy the return on gold across different columns, I actually want the column to stay the same. So I want to lock in the column. I'm not going to lock in the row, because when I copy that down for different months, I want it to grab a different month. So we need to do that. But we also need to lock the return on Apple. And again, we're just going to lock the column coordinate B, so that when we copy this formula across different weights, across different columns, it always refers to column B, because that's where the return on Apple is. So if I hit enter here, I got 13%, so it rounds 12.89 to 13%. That's fine, that's reasonable, because it's 100% Apple. And if I do Control R here, at the end, I just have a 100% gold, and that's 3%. If I do it 50-50, 8 is really an average of 13 and 3, roughly speaking. Yeah, because 13 plus 3 is 16 divided by 2 is about 8. Okay, so that works. Of course, we want this to be copied all the way down. So we're gonna highlight that row and hit Control D. All right, let's see if this all worked. If we locked all the cells correctly, what are we taking here? Yeah, that's correct. We're calculating return on the portfolio in February 2022, and we're taking returns on Apple and Gold from February 2022. Of course, we're taking the weight from up here from E4. So that all makes sense. Over here, that also we're grabbing all the right cells. So that makes a lot of sense. Here we just again repeating the weights. And so what can we do now? Now we can calculate average return and standard deviation. So we're going to do average, oops, average, and I'll hit tab key, and we can highlight all of these cells from E5 to E64. That's the average return. If we do 100% Apple, let's calculate the standard deviation using the sample formula. And again, using that same range of cells. That's perfect. Can certainly calculate the variance. Variance is just standard deviation squared. So we can do that as well. And we can copy this cell to the right. All right, so if we do just gold, the average return is 0.7, but the risk is also much lower. If we do 100% Apple, average return is 3% per month, but the standard deviation is also very high. Okay, fantastic. So this gives us the risk, and basically these two rows gives us the risk and return characteristics of different portfolios that mix Apple and Gold, which is really nice. And we actually have a picture for this. Look at that. We actually are plotting the risk of each portfolio on the horizontal axis and the return of each portfolio on the vertical axis. So up here, this portfolio here is really the highest return, which is 100% Apple, 0% Gold. And down here, we've got the lowest risk. That's that looks like 0.1% of Apple and 90%, sorry, yeah, 1% of Apple, 90% Gold, and we get this particular return. We get, now let's see. No, actually, that's not. So the minimum risk is 0.9. Apple, no, 0.1 Apple, 0.9 Gold. So these are 10, or actually 11 different data points, each representing risk and return of different portfolios. So this is we call this our opportunity set, right? These are the opportunities that we have if we have only Apple and Gold, and we have to mix them. So we can create different portfolios, and these are the different combinations of risk and return that are available to us. So there's another way we could calculate the risk and return, and let's do it the other way. The first way we did here was, I would call that really a brute force way, because we just took the individual returns from each month and calculated lots of returns for lots of different portfolios for all the different months, and then calculated average returns and standard deviations. But it turns out, if you look at our formula sheet, that if you have two risky assets and you know the covariance and variances of each of these assets, that is, if you know the variance of asset A and variance of asset B, and you know the covariance between those two assets, then there's a linear relationship between the variance of the portfolio and the variance of each asset and their covariances. And that's captured in this formula right here. Because the return itself is a linear combination of, well, so the return on the portfolio is a linear combination of the return on the individual assets, and therefore we can solve for variance. We don't have to create all the time series of each of these portfolios and calculate standard deviation that way. We can calculate standard deviation by just calculating variance and then taking a square root. So let's do that. Let's apply that. Let's apply this formula. Let's see if we get the same numbers. So for that, we need the correlation. We need a correlation coefficient between the individual returns, or rather we need a covariance, but let's calculate both correlation and covariance, because correlation is more easily interpreted. So let's do that. I'm going to do correl, and I have two arrays, and the first array is my apple. The second array is my return on gold. I'm going up here, close the parentheses, and I see that there's a 0.1 correlation between the return on apple and gold. What is the covariance? Covariance is, well, we can actually calculate it different ways, but sure, let's do it first this way. Covariance, we're going to use the sample formula. And again, we're going to take this range, comma, and this range, comma, and hit enter. So the covariance is 0.0003. Let's also calculate the variance and standard deviation and average return of individual apple and gold, which means I can just copy these three formulas here. So I have them in one place. I have them right underneath the apple return. I have their average, standard deviation, variance. Underneath gold, I have average, standard deviation, and variance. Okay. So standard deviation of each portfolio calculated. So let's do that. Let's apply that formula from the formula sheet. So what do I need? So for this is a formula for variance. So I'll need to square root this whole thing so that I get a standard deviation. And let's do that. So it's going to be a pretty long formula. We're going to do a square root of, and we are taking what? We're taking the, just silence this. We're taking the weight of asset A, just down here, squared. Right? The formula says we need to square the weight, multiplied by the variance of asset A, which is apple, and the variance is here, plus the weight on asset B squared, which is 1 minus weight on asset A squared times variance of asset B, which is gold, plus 2 times covariance. Okay, we actually have covariance. Where do we have covariance? We already calculated covariance. Covariance is here. I'm going to close that, and that should work. Now, I'm going to be copying this formula to the right. And so I need to decide which cells need to be locked. And it's certainly the covariance needs to be locked, because that doesn't change. We always want to grab it from B72. The variances should also be locked. We always grab them from the same cell. And so this is the first variance and the second variance. They're both locked. The weights, they don't have to be locked. Certainly the columns shouldn't be locked, and we're not going to be copying it across different rows, so we don't need to bother locking the rows. I think this should work. All right, so plus 2 times covariance. It's not just plus 2 times covariance, it's plus 2 times the weight on A times weight on B times covariance. So I'm gonna put that in there. So I'm gonna do this, and this has to be plus, and we'll do weight on apple times 1 minus weight on apple times the covariance. Okay, so we get the same number. So we get the same number as when we did it using a brute force. Let's see if we get that all the way across. Control R, get the same numbers. Okay, excellent. So, so we are in good shape. Really, this was just an alternative way of calculating standard deviations, right? Nothing happened to our graph here. So let's examine this opportunity set a little more closely. Let's ask what is the minimum variance? So sure, let's grab this row. What is the minimum variance? And that's when the standard deviation is 3.44. That's the lowest variance. And what is the apple weight for that? Apple weight is 0.1. Right? 0.1 is the weight of apple in the minimum variance portfolio. So that's when we mix apple 10%, gold 90%. Which portfolio would you pick if you were maximizing return regardless of risk? So what is the maximum return? So sure, let's do this, and we can of course do it by hand, but we can also help ourselves with the max function. Well, that's 8.49. That's when we're 100% apple. That's the maximum return. What is the weight of apple? 1. Which portfolios make the efficient set? So what does it mean for a portfolio to be efficient? Portfolio is efficient if there is no other portfolio that has a higher return with the same amount of risk. So for example, if we take a portfolio here, this one that I'm hovering over, that has a risk of maybe 3.7. Is there a portfolio, a feasible portfolio that has a higher return with the same amount of risk? No, that's an efficient portfolio. I can't do any better. I can get higher return, but at the cost of higher risk. So this is still an efficient portfolio. It's not the maximum return portfolio. It's the it's not minimum risk portfolio, but it's an efficient portfolio. I can't get any higher return for the same level of risk. However, if you examine this point down here, this low point down here, that is a portfolio that has a risk of maybe 3.5. Can I get a higher return with the same amount of risk? Yes, I can. I can go up here. I can pick a portfolio right here, this one. Right? This one has the same amount of risk, but higher return. So clearly, this portfolio here is not efficient. Essentially, the efficient portfolios are the ones that go here from the minimum risk up. All these, this one, all of these are efficient because you can't do any better. You can't get a higher return with the same amount of risk. Okay, Sharpe ratio. How do we calculate Sharpe ratio? Sharpe ratio is just, we know the formula. It's the average return, which is here, minus the risk-free return, which is here. And actually, let's lock that one. Divided by risk. It's then measured by standard deviation. So the Sharpe ratio for the 100% Apple portfolio is 0.392. We can copy that all the way here, Control R, to get to Sharpe ratio associated with each and every one of these portfolios. Which portfolio has the maximum Sharpe ratio? Well, let's calculate that. So right here, it's a portfolio that has a Sharpe ratio 0.421. Which one is it? It's this one here. It's the one where the assets are mixed 50-50. Let's actually put a nice border around this, nice thick border outside. Okay. That's our maximum Sharpe portfolio, maximum Sharpe ratio portfolio. And what is the Apple weight in that portfolio? 0.5. What is gold weight? 0.5. Okay. No. We call that a tangency portfolio. The portfolio that on the efficient frontier that gives us the maximum Sharpe ratio is called the tangency portfolio. So that's terrific. It's probably one of these, this one or this one. Now, it turns out that the tangency portfolio is a very special portfolio. That's a portfolio that all investors should hold, because that's the portfolio that going to give them the best risk and return trade-off. It turns out that if I now am able to mix not just Apple and gold, but also a risk-free asset, I can create a portfolios of Apple, gold, and risk-free asset that have certain risk and return characteristics. And the best portfolios in that set will be the portfolios that mix Apple and gold 50-50. Because Apple and gold 50-50 has the highest Sharpe ratio. So I'm going to mix the tangency portfolio, the 50-50 portfolio, with different shares of risk-free asset. So let's see how that is going to work. So I'm going to call this a weight of risk-free asset in a portfolio. And let's calculate the average return of that portfolio. So that will be, we're going to take the weight, multiply the weight on the risk-free asset, multiply by the return on the risk-free asset, locking in the risk-free asset. and plus 1 minus the weight on a risk-free asset times the return on the tangency portfolio. Because remember, we're just mixing risk-free asset with the tangency portfolio. The tangency portfolio is 50-50 Apple Gold. The return on 50-50 Apple Gold is in here, this guy here. I'm gonna lock that. When we are 100% risk-free, then the return is just 0.01%. If we change how much, Control R, Apple, we add, the average return, of course, changes. Namely, if we have 0% of risk-free asset and 100% of the tangency portfolio, the average return is 2.02, which is the return on the tangency portfolio. Now, it turns out that we can actually do more than just have 0% of a risk-free asset. In addition, we can borrow. And if we can borrow at the risk-free rate, we can take some of that borrowed money and invest it into the tangency portfolio. And that's going to give us even higher return. Just imagine here, if we borrow 50, if we start with $100 and we borrow $50, then we can invest in the tangency portfolio $150, and so we're going to get even a higher return. Of course, we're going to get higher risk as well. And so let's calculate the risk. And so here, we have two assets and the linear combination of those two assets, but the formula is going to be simpler because the risk-free asset, by definition, has zero variance and it has zero covariance. So if I look at what the variance of the portfolio that mixes risk-free return and the tangency looks like, it's just the squared of the weight on the risky portfolio times the variance of the risky portfolio. So let's apply that here. So in our case, that's going to be, well, the weight on the risky portfolio is 1 minus the weight on the risk-free portfolio. Now we're doing standard deviation, so we don't need to square it because we're going to square it and then immediately we're going to take square root of that. And the same thing with variance because we need standard deviation. So we're going to multiply that by variance, sorry, by standard deviation again, standard deviation of the risky portfolio, which is the tangency portfolio. And the standard deviation of the tangency portfolio is this number right here. And that number we need to lock. As we always going to be just mixing different weights of a risk-free asset with the tangency portfolio. And the variance of the tangency portfolio or standard deviation of the tangency portfolio is that number, 4.77. Let's hit enter. Of course, if we're 100% in a risk-free asset, then the standard deviation is 0. That's to be expected. And if we Control R this all the way across, what do we have? We have a little more risk if we take 90% risk-free asset and 10% the tangency portfolio. And as we increase, as we get more and more into the risky tangency portfolio, we increase our risk. And turns out that this combination of risk and return is actually lined up in a straight line. And we see that on the graph, and we call that graph the capital market line. So the capital market line tells us the different combinations of risk-free and tangency portfolio and the risk and return associated with each of these combinations. That line touches as a tangent to the opportunity set, and it's a tangent at the tangency portfolio. So there you have the reason for why the maximum Sharpe ratio on the opportunity set is called tangency portfolio. So that's terrific, and this now is our new opportunity set, so to speak, because now if we allow to mix a risk-free asset with the tangency portfolio, we can achieve a risk and return combination anywhere on this gray line. Right? So for instance, if I'm really uncomfortable with the amount of risk that Apple and Gold gives me, right? Previously, the minimum risk I could achieve was getting here, somewhere here on this orange line here. But now I know I can go lower. I can get less risk than that. I can just throw in a bunch of risk-free asset, a bunch of treasuries. I'm going to hold some cash, right? And that's going to get me maybe to this point, or even to this point. Of course, this is a all of these points are efficient because they're giving me higher return for a given level of risk. I mean, here, if I move actually from this point to this point, I'm definitely better off. I'm definitely better off holding the tangency portfolio with some risk-free asset and getting to this point, because this point gives me the same return as this point here, but at much lower risk. And so that's why no one is ever going to hold the this particular combination of Apple and Gold, the minimum variance portfolio of Apple and Gold, because they can do better holding the maximum Sharpe ratio of combination of Apple and Gold, which is 50-50 Apple and Gold, and then adding some risk-free asset to lower the risk of that tangency portfolio. So let's do some examples. For example, suppose that the maximum risk you're willing to accept is a standard deviation of 2%. What would you invest in? Well, maximum that maximum standard deviation is 2%. So, well, where does that take me? That takes me to basically this portfolio here. So I would invest 0.6 in risk-free asset, and the rest of it I would invest in the tangency portfolio. And the tangency portfolio is 50-50 Apple and Gold. And so that gets me to 0.2 Apple, 0.2 Gold. Suppose that the maximum risk I'm willing to accept is a standard deviation of 8%. What would I invest in? Well, 8%, well, okay, I guess that takes me all the way to here, this portfolio here. So I'm going to borrow $60. I'm going to put a negative weight of 0.6 here. And then I'm going to invest 50-50 Apple and Gold, which will be 0.8 Apple, 0.8 Gold, right? The sum of the weights is going to be equal to 1, right? If I have a negative 0.6 and then I have 0.8, that adds up to 1, right? So when you picture it, I start with $100, I borrow $60, and I have $160. 80 of it I invest in Apple, 80 of it I invest in Gold, and that's my portfolio. And that portfolio is going to get me average return of 3.22 and a risk of 7.6. So what drives the variance of the portfolio of two risky assets? It's three things. It's the individual variances. So variance of asset A, variance of asset B, and a covariance. And we're going to play with that in the toy model. So not in this video, but maybe in another video. What drives the variance of the portfolio of the risk-free asset in the tangency portfolio? Well, it's just the amount of how much risk-free asset we put into the portfolio. If I want to have a very little risk, I'm just going to keep my money in cash, keep my money in treasuries in the risk-free asset. If I want more risk, I buy the tangency portfolio and hold less of the risk-free asset, or even borrow the risk-free asset, and that's going to drive the risk of the portfolio that mixes tangency and risk-free asset. So that's a lot of material. I'm going to stop here, and in the next video, I'm going to work our way through the toy model.